Asian markets were mixed Friday, with Shanghai bouncing back from earlier losses, ending the week with a rally. This followed an intervention by China's top financial officials in a bid to shore up confidence in Chinese equities. It also came on news that the Chinese economy grew 6.5% in the third quarter, that being the slowest pace of growth since 2009. Japanese stocks booked their third straight week of declines after tracking losses on Wall Street and in Europe. Due to risk aversion, the Japanese yen was firmer, which proved a dampener for export counters. The Nikkei share average fell 0.6%. After a negative start to proceedings, Hong Kong stocks closed up in positive territory in line with China. The Hang Seng Index was up 0.4%. Chinese stocks rose after authorities intervened to boost confidence in the market following that negative news on China's third quarter GDP growth number. The Shanghai Composite Index rose 2.6%. Over the United States, stocks fell more than 1% on Thursday as the European Commission issued a warning regarding Italy's budget, and concerns mounted over the possibility of strained relations between the United States and Saudi Arabia, denting investors' appetite for risk. The Dow Jones Industrial Average fell 1.27%, the S&P 500 lost 1.36%, and the Nasdaq Composite dropped 2.02%. Well, it's been a turbulent week on global markets, with South African markets also getting caught in the crosshairs. There are worries about higher US interest rates. The Italians appear not to be playing ball in drafting an EU-compliant budget, and markets are getting rattled about China's growth trajectory. Apart from the Chinese and Hong Kong markets closing up into positive territory, today is generally a red day on global equities, with the local all-share index following in tow. The oil market has perked up today, although it's the second consecutive week that the commodities prices have trended downward. Let's take a look at the indicators. Well, for more on the markets, I'm joined by Viv Govinder from Rand Swiss, who joins us now from the JSE. Thanks very much for joining us, Viv. Why are we seeing a risk-off sentiment so badly now?
We have a number of really major risk factors in the market that are obviously spooking investors. We have, of course, like you mentioned, the Saudi Arabia, US debacle. If we do see a serious move against Saudi Arabia, and they react negatively by, for instance, doing something with regards to oil supply, we could see oil prices spike up double-digit percentage points very easily. That will be very negative for not just for the global economy, but more specifically for emerging markets like South Africa. That's one. We have, of course, the issues around China and the US. We have weakening Chinese growth, which is, of course, negative for us in South Africa as well, because we export quite a bit of raw materials to China. And we, of course, have this brewing issue in Europe, which hasn't really hit the headlines like it should, I think. We have a populist government that's been elected in Italy. And to give you an idea, it's effectively, imagine if Peter Dek started a party, and that party basically won the South African elections. That's what happened in Italy. A comedian started a party, and that party effectively became one of the coalition partners in the government. So at the moment, the Italian situation is very troublesome. These guys got elected on a very populist platform, and it's not so certain that they will back down because of pressure from the EU.
So if they don't back down and they have this budget that's not compliant with the EU rules, what then are the implications for the euro and ultimately for South Africa?
Well, the problem in the Eurozone, it's very, a very unstable system. I mean, it's not like a currency applying to a single country. Like South Africa has the rand, and, the UK has the pound, and the US has the dollar. This is the same currency applied across various countries which have different, problems. So imagine South Africa and Zimbabwe shared a currency. And then imagine Zimbabwe did what Zimbabwe did. I mean, how would South Africa have to react to that? It's not quite as bad as with Italy at the moment, but they are doing things that in a normal situation would weaken their currency, because because of the moves they're making with regards to budget deficits and so on. But because they're part of the European Union, the Eurozone region, countries like Germany and France and so on are along for the ride with what Italy is doing, and they obviously have to react, negatively to this. According to Juncker, from Germany, we have, the European Eurozone rather has given Italy quite a lot of accommodation with regards to the budget deficit. But what they're asking for right now is just too far a step for them, and so we are coming to a point where either Italy backs down or the European or the Eurozone rather region backs down. I'm not so sure which one is going to be.
Viv, of course, I mentioned at the top about that Chinese growth print coming in at 6.5% in the third quarter. I mean, if South Africa could achieve those kind of growth numbers, that would be wow. But people are saying that's a bad number. Is it a bad number? And therefore, what impact will that have on commodities?
Yeah, it is a bad number because we don't expect the Chinese to usually miss their GDP targets. They missed by a small fraction of a percent, but they still missed it. And that hardly ever happens. And when the Chinese do miss, they tend to basically take some rather extraordinary measures to make sure they get back on track. The Chinese economy is maturing. It can't grow at 8 or 7%, 8% indefinitely. They're getting to a point right now where they have to obviously slow down their growth rate. A lot of the advantages they had in the past, for instance, this massive workforce that they could exploit, is to a certain extent diminishing. That's why they've had to remove things like the one-child policy. So the Chinese economy is coming in for a bit of a slowdown. And if the government basically insists on maintaining unrealistically high growth rates, it might just cause a bigger crash in the future than letting it slow down a bit more in the present. But like you mentioned, China hugely important in the commodity market, and therefore it's going to be very important for companies like Kumba, for instance, which produces iron ore. China basically takes in more than half of the world's seaborne iron ore, so it's a huge factor in that market. But looking at the overall picture, like I said, we do have to expect the Chinese economy to slow down significantly over the next decade or two.
Viv, I wanted us to take a look at a couple of stocks. Obviously, the local ore share market has also been hit with this global contagion of stock equity prices going down. But if we look at Mediclinic, for example, they made an announcement not that long ago that their earnings wouldn't be so great, and the market reacted by selling them off by about 19%. They closed down about 17% on the day, and they've continued to fall. Why such a massive backlash?
Well, I think the problem is that analysts right now are a bit nervous about the management's predictions. They had been assured in the past that the worst was over and things were turning around and it wasn't going to be this bad. And then when these results came out, they were contrary to some of the promises that had been given by management in the past, which obviously is not a great thing. It's only betrays your trust. You obviously have to worry about everything that they have said. And so I think that's one of the main reasons, because the actual results themselves wouldn't probably have justified such a big sell-off. I think it was the erosion of trust between analysts and management that maybe caused things to go a bit overboard like it has, and that's why we saw such a massive pullback in the company.
Viv, we're running out of time, but just very briefly, where is the bottom? Do we have more bottom to come?
No, the bottom is going to be very far from here, but I'm not so sure this is the time we get to the bottom. Look, I mean, we haven't had a serious pullback in global markets for about 10 years now, 2008 till now. We need to see something more than this to actually clean out some of the cobwebs in the system. So even though our market, our local market, has been under a great deal of pressure, and in hard currency terms, we in South Africa have done really badly, I think the global markets have yet to really experience, especially the US market, has yet to really experience a proper pullback to basically clean out, like I said, mispricings and so on. So even though we might recover from here, I still expect, somewhere down the line to have a more, significant pullback than what we experienced thus far.
Viv, thank you very much for your time and your insights. That was Viv Govinder. He's from Rand Swiss. After a short break, more news for you.